Welcome back to this Moneycontrol live stream. You're watching Closing Bell with me, Nandita Khemka.
And I'm Yatin Mota.
Well, Yatin, no Friday cheer. Of course, we saw the Nifty, resume sell-off. In fact, the market resumed its sell-off after a day-long break. Yesterday, it was a good session, but as the mutual funds, came out with the stress test results that were mandated by SEBI AMFI, there was a fair bit of nervousness, and that was pretty much evident, given the fact that the texture of the market was towards, the downside. So the Nifty managed to hold on to that 22,000 mark. We trimmed some of the losses. The mid-cap index also ended the day in the red, but the small-cap index managed to hold out, Yatin, ended high by about some 0.5% or thereabouts. If you look at the market breadth today, it was evenly distributed between gainers and losers, almost 1:1. Sectorally, most of them were in the red, including the auto pack. Oil and gas, of course, OMCs took a hit after the fuel price cut of 2 rupees a litre. And aside of that, pharma, realty, all these pockets were under pressure. Among the losers on the Nifty, you had the likes of M&M, BPCL, Coal India, Tata Motors, HCL Tech, L&T, and on the gaining front, you had UPL. That was the top gainer. Airtel, Bajaj Finance as well held out. Hindalco and HDFC Life were the other ones. Yatin, looking at the broader end of the market, fairly mixed. I think we did pair some of the losses, intraday losses, but the Nifty small cap index managed to hold out. But there was a fair bit of nervousness in the market today, Yatin.
Absolutely, and today, despite the fact that there was a FTSE rebalancing which was overall buy, the benchmark indices did not recover as much as expected. In fact, if you look at the Sensex, Nifty, off days low, but yes, still a triple-digit loss coming in on an absolute basis. Obviously, the mid-cap index was in the green, but if you look at the market breadth, slightly weaker than most of the expectations. Now, if you look at the Nifty 500, obviously the losers are oil marketing companies, but apart from that, PSU stocks like PFC, REC, BHEL, NBCC, Engineers India, they continue to languish and trade under pressure. In fact, all of these stocks that I mentioned traded anywhere between 4 to 6% lower on an average. Auto stocks also witnessed some bit of selling in trade today, be it Tata Motors, Mahindra and Mahindra, TVS Motors. All of these stocks were down anywhere between 2 to 5%.
Right, the big cuts that we saw was across the OMC basket. Correct. Right? There was a 2 rupee cut in petrol and diesel prices, and that was something that the market was anticipating, but they weren't sure about what the quantum of the cut will be. So most of the brokerages maintained that an overhang is out of the way, and 2 rupees kind of a cut was something that there's maybe slightly lower than what the street was anticipating. The view remains pretty much mixed on the OMC basket. Look at CLSA; it had recently downgraded the OMCs and has retained its sell rating. It says that 2 rupee cut in prices of diesel and petrol may be a big derating event. That's something that it had already maintained a bearish view on the OMCs, given the fact that they've run up so much. Now, marketing margins will of course be curtailed, or they will shrink, and in fact the diesel margin is now below fair levels. That's what CLSA is saying, and this cut could challenge the optimistic narrative of the government. And of course, stock prices, according to CLSA, are baking in a much higher than long-term average refining as well as marketing margins. But Citi and Morgan Stanley have taken a more constructive view on the OMC basket. Citi has maintained that the price cut was unwarranted but not entirely unexpected. Crude prices breaching that $85 per barrel mark, price cut in diesel, according to Citi, was not really warranted at the current juncture. In fact, marketing margins, according to Citi, are already hovering around break-even levels, and this will further squeeze marketing margins for the likes of HPCL, which of course has a higher, market volumes, right, rather than refining volumes. And aside of that, Citi has said, but any meaningful pullback could be a good buying opportunity for the medium term. Morgan Stanley also has pretty much the same thought process. It says that the auto fuel price cut was largely expected, and it also removes a key overhang. And it prefers IOC, given the fact that refining exposure is higher for IOC, and of course it will benefit this particular company. HPCL, according to Morgan Stanley, may see negative near-term impact, but it also maintains a pretty okay or bullish view on HPCL as well, saying that any pullback could be a good buying opportunity for HPCL. So all in all, mixed view continues, but we have seen a fair bit of run up in OMC shares. But we have to keep in mind what CLSA has to say, saying that there could be a big derating after this fuel price cut.
And in fact, CLSA went ahead and said that the prices are already factoring in a super premium GRMs or the refining margins, which might not sustain moving ahead. But in the banking space, we have various stocks which were in focus now. If you look at Axis Bank, one of the brokerages had a report on Axis Bank, which is Nomura. They have a buy call on Axis Bank with a target of 1250. Now, obviously, in the last quarter, we have seen Axis Bank had seen better net interest margins versus the peer set, especially HDFC Bank, and it still trades at a lower premium to ICICI Bank and HDFC Bank in the private banking space. In fact, Nomura says that obviously deposit is a challenge for most of these private sector banks because the CASA ratio has seen slight weakness in the past few quarters. But moving ahead, they expect the benign credit cost to help the bank invest in their overall franchise and branch expansion. In fact, they are expecting the deposit growth and a loan growth of 10 to 12%. In fact, they are expecting a earnings growth of nearly 15%, and they expect that the company, which is Axis Bank, will grow nearly 400 to 600 basis points, meaning 4 to 6% higher than the credit growth which is there on an average for Indian banks.
Right, but I think Axis Bank is one of those private banks that has fared better than some of the peers like HDFC Bank and Kotak Bank, right? The other stock on my list today is Aurobindo Pharma. It has not had a very good year thus far. It has been on US FDA's radar, and there was an inspection at its Telangana unit back in Feb. After which 7 observations were slapped on its Telangana unit. Now, CNBC TV18 has caught hold of what those observations were or the nature of observations. US FDA has said that the procedures to prevent contamination was not followed. In fact, there were no written records maintained, and that led to unexplained discrepancy as well. Equipments were also not suitably located to facilitate operations. Aside of that, of course, the US FDA setback is something that has weighed in on the stock price, given the fact that it is down somewhere around 7% on a YTD basis. But if you look at the 1 year performance, the stock has done fairly well, over 100% kind of gains. It is one of the low PE stocks in the within the pharma basket at at a 12-month trailing PE of 20x or thereabouts. But there are concerns when it comes to the return on equity has been on the lower side. Q3 was fairly good, but of course the US FDA issues, these are, that in fact will decide as to which way the stock will head going forward. But I think even when the, US FDA inspection was going on, the stock came under a fair bit of selling pressure. And today as well, the stock ended lower by about 1% or thereabouts, no big cuts coming in. But there was a knee-jerk reaction, given the fact that the observations look like they're pretty serious in nature. Yatin.
Yeah, and I think the stock was already factoring in this move after the 483 details were disclosed. Obviously, Aurobindo Pharma is one of the cheapest pharma stocks in that particular market cap range. So we haven't seen a big reaction to the form of 483. Stock trading close to 1,000 rupees now.
Right, Yatin, a lot of overhangs looks like they are out of the way. The MF stress test results came out today. Advanced tax payments would be out of the way, right?
Correct.
So going forward, when you're talking to experts, what are you picking up? Do you think the kind of sell-off that we saw this week, do you think that is going to extend to next week, or do you think most of the overhang is now out of the way?
So there is a higher chance that it might extend to next week. The reason being that March end typically has a lot of book closures, tax adjustments, and as you were mentioning, advanced tax payments. A lot of portfolio rebalancing, rejigs happen. When it comes to the mid-cap, you might see some low volume action next week. But it's to be seen whether or not that mid-cap panic or that mid-cap sell-off really impacts the broader markets or the larger market picture. If you look at the markets today, obviously there was FTSE rebalancing, which led to a lot of FII flow in trade today. But for Monday, we need to watch as to how FIIs and domestic funds are positioning themselves in this volatile environment.
Right, of course, we'll also have the election dates coming out tomorrow. So, of course, some bit of, a reaction to that as well we can expect next week. But for now, not really ending the week on a good note. Yesterday was a breather and we were wondering whether it was a dead cat bounce or not. But let's see whether or not the texture of the market improves next week, or whether the selling in the broader end of the markets abates, or how things really go on. The next couple of weeks will be a decider. But with that, we've come to the end of this edition of Closing Bell. Of course, leaving the week on a tepid note, but let's see how things really pan out next week. From me and Yatin, thanks a lot for tuning in. Have a great weekend and come back and join us again on Monday morning with markets. Thank you.